Hello, fellow investors from InvestPro. Before we talk about markets, because markets and risks and many other interesting stuff is what I've prepared with you with my next guest, I want to spare some time on mentioning who are we talking to, because our guest tonight is known globally for saying things that most people don't want to hear when markets feel calm because he's not famous for hype or forecasts or some catchy headlines, but he's known for warning about risks before they show up in prices, before they materialize. And that's actually the better way to look at risks because when it starts raining, you don't need an umbrella. So, what many people don't know is that our guest has something related to Bulgaria, some Bulgarian roots, so to speak. And his story didn't start on Wall Street. And like many people here, his path involved immigration, adaptation, learning how system really work from the inside, and that's what helped him in his journey into Wall Street. So tonight's conversation is not about predictions; it's about understanding how markets behave when everybody feels safe, and why the safety can be misleading very often. Without further ado, let's welcome our special guest from the US, Чем Карсан. Чем, it's a great honor to welcome you to InvestProConf.
Yeah, pleasure to be here, and look forward to having a unique conversation. As you mentioned, I have Bulgarian roots, so it's really nice to connect back to kind of the homeland of my grandfather.
Yeah. Yeah, so let's
as well.
just
So
continue.
thank you for having
Tell
me.
us about how you came to Wall Street, how you went from Turkey to Wall Street. Yeah, but give us an intro about your story.
Yeah, yeah. I'll start even way before that. I'll start with my grandfather, just to kind of give the audience a little bit of a background on my connection to Bulgaria. But my grandfather on my mother's side was very, very close. He grew up in Bulgaria, in Sofia. This would have been uh, right after kind of First World War, right? And in the 30s, this was a time, as you might imagine, where Bulgaria and Turkey was just being created as a republic, right? It was kind of the ex-Ottoman Empire, and so, as many other countries, as happened in many other countries in that part of the world, there was a bit of an exodus. Some people left kind of what was Asia Minor to go back to their lands, whether it's Greece or Turkey or Greece or Bulgaria or Armenia, all over the world. And the same was happening. The part that doesn't get told is the same was happening the other way, right? A lot of the Turks from the Ottomans from all over the empire, which was started in the 1400s, right? Long, long time, found their way back. And so my grandfather left Bulgaria, climbed over mountains. There's stories of him having gold sewn into the hem of his clothes, right? And he was the oldest of 7 children, which was kind of common at that time, right? And he was the only one that was old enough to kind of leave. And so he left and found his way to Turkey. And there had been a gentleman at a bank in Turkey who ran, kind of was a CEO type executive at one of the biggest banks in Turkey, who had come to speak in Bulgaria when he was there still as a senior in high school. And he had, as a senior in high school, toured him around because he was of Turkish kind of heritage and whatnot. And they had connected, and the man had given him his business card and said, "If you ever come to Turkey, I'd love to hear from you." And so he showed up at the border with this card. That's it, tattered and torn from years earlier. And when he showed up, and they caught him at the border, he showed him this card, and people knew who he was, the man was, and they took him to the man. They called him and came send a car for him, and ended up adopting him and making him his son. And so that's my, grandfather's origin story from Bulgaria, but an incredibly different time. and again, a wonderful connection to that part of the world. So, but that's how it starts. My story goes a little bit, further down that immigration story. My parents are both Turkish. Were born and raised in Turkey, different parts, but end up in Istanbul ultimately. And my dad was a PhD structural engineer at the time, kind of first in his class at one of the best universities in Istanbul. And he got a Fulbright scholarship to come to the US to get his PhD. And so he came to the United States. Again, America is a country of immigrants. And he was one of those many immigrants who made his own kind of footprint here. He has more than 10 patents in the design of offshore oil platforms. So he came to Houston, Texas, which is the kind of energy capital of the U.S. and really the world in many ways. And he started in the offshore oil industry. And so there was a trip to London on the way. I was born in London. They were there for several years as part of that, and then eventually back to Houston. And so I grew up in Houston, Texas, as a Turkish kid named Cem, C-E-M. So very different upbringing. The American experience is one of, every part of America is very different than one another. And even within it, there is a microcosm of all these different cultures, right? And Houston's very much a melting pot, but Texas is its own thing. And so I grew up with I tell people as what's called a third culture kid, somebody who really didn't have his own embedded culture, right? When you grow up, I think in Bulgaria or Turkey or one place where you are embedded in one culture, you tend to take on the general cultural perspectives of that group. But for me, I would look at my parents who were Turkish and thought differently about the world. And I look at the people around me in Texas who thought very differently about the world. And both didn't jive for me and both were almost a bit odd, particularly because I was stuck between the two. And I realized that neither made a lot of sense often. And so I really grew up with this third party kind of view, trying to suspect of conventional wisdom and often thinking outside the box, which is really I didn't realize till I was maybe 40 how important that was. But I think that's a big part of how I see the world and who I am. But that's how it starts. My parents moved to Norway when I am 14. And they go to, my dad's leading an offshore oil project in the North Sea. And as part of that, I go to a prep school and leave home at 14 and have an incredibly different kind of international experience, people from all over the world at a school called Andover on the East Coast of the United States. And that was really an incredible opportunity to find kind of people more like me, right? Kind of these third culture kids from all over the world in a sense. And that was incredible. I got a scholarship when I went to college. My parents gave me the money they had saved. I've been interested in markets, but really more geopolitics, policy. And I was really thinking I might study engineering. That's how my brain works, much more quantitative modeling and thinking about, everything's a machine. Everything is a problem to be solved. And so I went to college thinking I would do that. And, this is 1995, and this is when markets did a hockey stick all the way to 2000, one of the best, that 5 years, one of the best time in markets ever. And so, I started investing in 95 and got the bug. And before I knew it, I had taken a lot of the statistics and programming that I was learning in my engineering classes, started deploying them to quantitative modeling and thinking about markets throughout college. And eventually that led me to Chicago, where I became an options market maker out of college and eventually started my own market making operation, which became one of the biggest options market makers in the world. So at our peak, we were 13% of the volume of the S&P 500 options and more than 10% of all equity options at the time. And that was during the great financial crisis during 08, 09. So talk about risk, learned a lot about risk and managing risk, options, volatility, how to use derivatives, the importance of that and whatnot. But I've also, having started in this business in 98, really saw both the tech bubble burst as well as the great financial crisis and COVID. So I've navigated a lot of these from the inside and I've really gotten really unique experiences. So I sit here, today as somebody who's really had a kind of a unique kind of upbringing, multipolar kind of education as a child. and importantly, kind of look from the inside in markets on market
Well,
microstructure
very interesting
about how the two
story.
connect in a way.
I cannot just point out that you have several big bear markets under your belt. If you're talking starting in '95, right? So you went through the dot-com bubble, you went through the 2008 great financial crisis, which was baptism year for me too. I was just a few years on the markets as a stockbroker here at one of the largest investment intermediaries in Bulgaria. So I saw it from firsthand what it means. A very, very different environment than what we have now. And you've witnessed also the rise of structured products, ETFs, which have completely reshaped the markets in the last 15 years or so. So index investing is not new per se, but ETFs have just swallowed a lot of the investment flow in the recent years. And here in Bulgaria, many people invest by buying one or two big and currency unhedged ETFs on S&P or Nasdaq, and they're holding them for years. And it feels calm and automatic thanks to the fintech apps and so on, which is easy for the last 10, 15 years, right? Combining the strength of the dollar and the US markets alone. But do you believe, given your experience, given your knowledge about risk, about derivatives, about flow, we'll delve about it later, but do you believe this comfort that nowadays investors who haven't had experience in a crisis, in something deep that shakes them in a way, that is a big problem, especially if markets fall hard at the same time for everybody. Yeah, now everything is connected more so than ever.
Yeah, importantly, I've had those experiences of multiple crises, but I think it's important to note that I'm also a student of history. My father is a big history buff, wrote history books as a hobby. It's something I grew up around. Hard to not be from, to be from Turkey and not be kind of a student of history, I think, and to some extent, that part of the world has played a major role for a long time. But I'm also, really think about the world in really statistics and models, right? And I think that taking those perspectives really gives you being able to back up and think about the big picture is something that not many people, unfortunately, do enough of. There is a lot of recency bias, as you kind of highlight, kind of insinuate, which is absolutely true, in how people invest. Partially because markets themselves have evolved tremendously during the last 40 years. And as they've evolved and become bigger, and there's been a huge financialization, right, of the whole economy, as you highlight. And during that time, there is a reflexive effect of all these people and the globalization and the investment coming online and driving under a very new kind of outcome too, which is a dramatic straight line decline, right, from 1982 of interest rates from 20% to zero, right? These dynamics have created a reaction function by the world that is very kind of momentum driven and very kind of two-dimensional. The ideas of passive investing and 60-40, this is actually something that is not communicated clearly to most investors. This is the majority, by the way. 95+% of the world invests in stocks and bonds and things that look like stocks and bonds, like venture capital, private equity, private credit, right? All of these things are stocks and bonds. Even real estate is a form of equity, right? And so all of these investments are the majority. Again, think of it as $500 trillion of global investments. But the reality is this type of approach of investing only long assets is actually quite new. Passive investing and 60-40, 60% stocks and 40% bonds did not actually exist as a core investment thesis until the 1980s. That's confusing for people. The Dow Jones Industrial Average was created as an index 100 years ago, but nobody really passively invested until 1985, 40 or so years ago. What happened to the first 60 years? Why did nobody invest in passively? It's sold to people like that is because the infrastructure wasn't there, or the idea wasn't there, or that it was an innovation. Not true. The reason people didn't invest in that way is because it didn't work before that. In 1985, if you look back 80 years, imagine you're somebody sitting in 1985, and you're looking back at history of the 80 years prior. The performance of the S&P, a 60-40 portfolio, in inflation-adjusted terms, adjusted for inflation, in that 80 years had 60 years, 20-year, 3 20-year periods, 2 decades each, 3 of them, where 60-40 made $0, 0%. Can you imagine? 1900 and 1920, a 60-40 stocks and bond portfolio with represented by a 10-year bond and 60% S&P put together from 1900 to 1920 made $0 in inflation-adjusted terms. 1929 to 1949, for 20 years again, with only a 9-year gap, the roaring 20s, 1929 and 1949, again, 20 years, 60-40 made nothing in inflation-adjusted terms, 0. And then 1963 to 1983, again, 20 years, same thing. If you're sitting in 1985 looking back at that, why in the world, if 60 of the 85 years experienced 0% returns with dramatic risk, would you passively invest? Why would you do 60-40 stocks and bonds? You wouldn't. And that's why people didn't. And that's the story that nobody talks about. It's sold as an innovation, as a dramatic change in the way investing happens. Cheap, low cost, do it, buy long. But the reason it's been so successful for the last 40 years is because interest rates peaked at 20% in 1982, and they made a straight line down. And the most obviously important thing to bonds is interest rates. That's obvious. But it's also the thing that nobody talks about is the most important thing for stocks. If interest rates are at 20%, nobody's going to go buy a 4% yield in the S&P 500. No one, literally no one. They're not going to buy a 10% yield. Maybe they'll buy a 15 based on growth. And not just that, when interest rates go up, profit margins go down. Profit margins are, over the long run, 1-to-1 correlated with interest rates. So not only do you get multiple contraction if interest rates go up, but you get profit margin contraction. And so we've seen the exact opposite for 40 years. So what happens if interest rates go up? This is the big thing that nobody talks about. The Sharpe ratio of the S&P 500 risk-adjusted returns is 0.35. I talk to registered investment advisors, RIAs, big investors all the time. I ask the question to these people who are in charge of making these decisions of 60-40. What is the Sharpe ratio of the S&P 500? You know how many in the last 2 years have known the answer to that question that haven't heard it from me already? 0. Nobody even knows what the Sharpe ratio is of the S&P 500. Nobody talks about it. We don't think about risk. We don't talk about risk because it's not something they want to talk about. Over 125 years, 0.35 Sharpe. That's pitiful. That's awful. On the average year, the S&P 500 draws down, on average, over 125 years, big data set, 15% every year, just over 14%. That's a very volatile asset. On average, every 8 years, you have a minimum drawdown of 40%. That's how often we get 40% or bigger drawdowns. You know what the max drawdown is in the S&P? 88%. If I brought that investment to you and you didn't know what it was, just a piece of paper, here's the track record, here are the stats, would never invest in it. But people put 60% of their net worth in it. Again, it's recency bias. It's been better in the last 40 years, but also people aren't educated on these ideas. So, and importantly, 60-40 has almost the exact same Sharpe ratio, 0.37. So there's almost no diversification benefit of stocks versus bonds over the long run. Now, in the last 40 years, those numbers are 0.5 and 0.6. 0.5 Sharpe ratio, so a little bit better, 50% better. S&P still not great. And 0.6 for 60-40. And this is why people do it, because it's worked better. And any risk that we have had hasn't been secular long multi-decade losses, right? Which is really what we used to see and what we're likely to see if interest rates go higher. So anyway, I'll stop there and I'll let you kind of jump in here. But I think that's the biggest picture idea I can give you on history and statistics. This is not a prediction of where the market's going next year. Although I will say there is a lag to interest rates, as Schiller writes very clearly in academic research. Over the long run, obviously, long-term interest rates are going to affect the valuation of stocks, right? Because there is a trade-off. Like I was saying, you're not going to own you can buy a 20% yielding 10-year bond from the US government. You're not going to buy stocks at 4. The problem is there's a lag to that. Why is there a lag? Because if everybody refinances at 0 for 5 to 7 years, they don't have to refinance. The effects of that higher interest rate don't hit the market until people have to refinance it. 2021, 5 years forward, 2026. So this is when these things start to matter. So it's not just if interest rates are going higher, they've already gone higher, but they've gone higher with a lag. And now comes
something to add on here is that recently bonds and stocks have been correlated a lot positively, which is another nail in the 60-40 coffin, so to speak. Yes, yeah.
But that's not uncommon in 125 years of history. It's just uncommon in the last 40 years.
And
that's the big
shift the topic to bonds and to what is being used of bond yields to give birth to other structured products, because nowadays there are a lot of investors and a lot of banks selling a certain type of a structured product that is reassuring for most investors, that you get some income and you're told your capital is protected unless something extreme happens. And these are the products that are called capital protected notes. As some of our viewers can know, we've talked about these in the last few years. But when markets do move into these extreme conditions that you just briefly sketched and portrayed, that they happen from time to time, what can be a problem? Because most of those products are issued by banks and by their so-called funding desks. So they are the counterparty for an amazing volume of money. So what do you think about all this? I mean, can it fire back? I mean, is it too safe, too sure?
Yeah, so I want to take this question in a slightly different direction, then circle back to the risks that you were talking about. The rise of structured products and ETFs that look like structured products, essentially things that are using options to structure non-correlated bets or less correlated bets, right? Things that are different than just long the market, are growing tremendously because of exactly the things I was just talking about. And I would argue these are very early innings. To paint a picture, you have $500 trillion of long assets in the world. That's stocks, bonds, real estate, things of that now. And about 3 years ago, things that I would consider more non-correlated, and those are like hedge fund strategies, structured products. I would also include that things like assets that are meant to be non-correlated, gold, crypto. That group of assets 3 years ago was about $7 trillion combined, all of it together. Gives you a sense of how small it is. It was. It's now tripled in just 3 years. You've had a tripling in assets. Some of those from a steady state, like gold was wallowing and now triple, right? Hedge fund assets were at 2 to 2.5 trillion for a decade, growing. And now they're 4.5 trillion the last 3 years. All of these things, structured products, sorry, that's the one that you're asking about. The most important, 500 billion just 3 years ago. Now over 2 trillion, quadrupled, 4 times the amount of assets, including ETFs and that, et cetera, that do the same thing. That dramatic growth is by early adopters. Those that looked at what happened in 22, saw that like bonds were no longer necessarily going to diversify them, see the risks that are coming, because people like me are talking about it and explaining why, and they're realizing, wow, 60-40 might not be okay in the next 10, 20 years. Mm. And so they're trying to diversify. And this is what's driving the supply and demand imbalance that's driving massive assets over there. But again, I want to highlight 20 trillion now versus 500. And just in the last year, we went from 450 to 500 on the other side, right? Because assets are going up because markets returned 17% last year. And bonds yielded, 4.5, right? So the big idea here is that this is early innings. And that if we do see a decade of what is likely, again, I'm not the only one calling for this generally, right? Druckenmiller, Soros, Buffett, Howard Marks, you name people who are kind of names that have been through these cycles, who think about these things in big historic terms, are saying the same thing. And so if we're heading into that type of a decade or two, right? Well, it's a small door, 20 million up from 7, and there's 500 trillion on the other side. And importantly, these things are incredibly more interesting now, not just because of the risks that we've highlighted, but because interest rates are higher. By definition, structured product options are incredibly capital efficient. Right? You're not putting the full amount of money into this asset. You're only putting a fraction for the positioning. And that means you can get, with the extra money, and this is embedded in the structured product when they create it, the yield that's now higher. So when interest rates were 0 and maybe a structured product yielded, let's say 5%, on 0, they stack on top of each other, you're only yielding 5%. That's not very compelling. But when the underlying capital part goes up to 4, now you can get the 4 and still get the 5%. So now these things are yielding more like 9%. So as interest rates go higher, these are on top of interest rate kind of products because they're capital efficient. And so not only are you dramatically at higher yields, and they will continue to scale as interest rates go higher if the interest rates go higher, but importantly, it's exactly at the moment where the risk and the need for non-correlation is dramatically higher. And so this is what's driving, these are the things driving that boom. So I don't want to just paint these structured products as things that are dangerous or not. I mean, arguably they're less dangerous, right, than being in stocks and bonds. And they're a way to move away and non-correlate yourself. Now, the problem with structured products specifically, and this doesn't really refer to ETFs, we'll get to that in a second. It's not the structuring and the value of that structured product. It's the fact that not a lot of people do it and did it until more recently. The ETFs are coming online. Lots of other opportunities to do it more directly are growing because of the demand. But because the primary issue of these are big banks and they're things that are complicated and there's not as much competition in, they are charging tremendous fees. Average structured product, when they structure the structure, they take about 1.5% out of the structuring. And then they charge fees on top of it of 1.5%. So the fees on these structured products from banks are very high, call it 3%, right, per year. And so these things, even though they're great products and great things, and people should use the power of options and positioning, for sure, they need to find ways to be more non-correlated. Unfortunately, that the fees are really high from the structured products, specifically 1 and 2, because they're getting issued by the bank, and then the bank is getting the things off the exchange. The exchanges the bank is the bank is hedged on their products and their counterparty is the US government. But what they're issuing is backed by them ultimately. And so you do have a credit risk. As we saw in 2008, these structured products had, and other things like them had significant risk because the banks themselves were at risk. Now, the question is, are we risking at this point? That is your risk. It's a tail risk. And we saw it in 2008. Are those banks as much as at risk as they used to? I would say no. Actually, banks benefit from a rising interest rate environment, have been doing better. There's more regulation on what they can and can't do. We've become more sophisticated with a lot of the risk. Does that mean that they're risk-free? Absolutely not. And you should be careful about who you're buying your structured product from. They're not all created equal. If you're buying a structured product from JP Morgan, you're probably okay, right? Or Morgan Stanley or Goldman Sachs, right? Be careful about kind of third tier structured product issuers and the risks that you're taking. Okay. But ultimately, there are risks there. You should be cognizant of it. But this is why the ETF kind of structured products, right, are growing dramatically. Because you don't need an intermediary to do this anymore. You don't need to pay the 3% fees anymore. Actually, we're in the process of launching an ETF that would, for these same reasons. And the reality is, if you can structure trades that are options based, that's essentially a structured product, into an ETF wrapper, it's on exchange. So your counterparty is the US government. You don't have that credit risk, right? In that situation. And again, the fees are maybe 75, 80 basis points as opposed to 3%. That's a way more compelling product. And there's a reason the growth in those ETFs have not been 2-3x. There's about a 1,000x increase in AUM in products like this.
I mean, I've been influenced a lot about derivatives by you in general, because you've mentioned many times that the option actually is now the underlying, because now you can trade plenty of dimensions like time, price, volatility, and let's focus just on the volatility type of characteristics in the option, because maybe it is related to the ETF that you just mentioned about, and maybe it will be interesting for our audience to learn how it can approach volatility in a way that is useful and not destructive at the same time, because most people, when they hear volatility, they try to stay away from it. They think of cryptocurrency, of stuff that can break their portfolio, but volatility is something that a lot of the great investors actually try to utilize in a good way. So let's steer the conversation in this direction, how we can use volatility in a good way.
Yeah. So I want to back up one step before we dive in again here. I think this is important. Similar to what I was saying about structured products, right? Options at their core, right? It's a little confusing to people, are simply a pricing of every moment on the distribution for every asset. So when people talk about volatility, by the way, they're talking not about, they like to talk about it in one dimension, like volatility as a measure. How volatile is this thing? Like a number. But what volatility is like if you look at a distribution, it's a wider distribution is more volatile, and a thinner distribution is less volatile, right? But it's not just about how thin the distribution is or wide, it's how the shape changes and how the moments of the distribution change. Volatility trading is not buying a vol or selling a vol. People want to think in two dimensions. It's about thinking about the distribution of assets and being able to position where you think there's a higher probability or lower probability of outcomes for any asset. Volatility is not an asset class. It is not an asset. It is not a thing that you trade that is different than the other things. It is the thing that underpins every asset. That's so critical to understand. And the reality is that we have all, since time incarnate in markets, because we started with the asset as the original investment, thought about investing as buying or selling a thing. Investing is buying or selling things. But we now have the ability to position dynamically with incredible precision on every asset to make very specific bets. I'm willing to bet you when you say, I want to buy something like a stock or a bond, that the idea that you have is much more sophisticated in your head than just stock good, stock bad. You have an opinion about certain outcome for that stock that may drive a positive outcome. But your opinion on what that might do to the outcome, it could be, I think there's limited downside in this, and I think it'll do relatively well, to, hey, I think this stock could go completely bankrupt if this doesn't work, but I think there's a high probability of this thing working, and if it does, it'll take over the market. Those are very different reasons to buy something. And the way you should bet means the distributions are dramatically different for those things. And so continuing to invest in a way that is in two dimensions is incredibly inefficient. You're taking on all of the risk and all of the capital of this asset when you buy something. Why would you take all of the risk? There are probably 70% of the risk of that distribution you may not have an opinion on or want to take a bet on. Go bet on the parts of the distribution that you believe are underpriced or overpriced. Go take the opinion that's in your head and put that more specifically into the bet that you're trying to make. That leads to better risk-adjusted returns. And importantly, it also means that you're not dedicating all your capital to all these other bets that you don't care about. So it's incredibly more capital efficient. This is what volatility is. This is what options are. It's way more nuanced than just a thing that is risky or wide or more. It's not an asset class. Now, you can be long volatility, which is a dynamic, which means you own something that has convex outcomes if you're right. Or you could be short volatility and be selling something that you think is overpriced on the distribution, and you'd like to take the premium for what you believe is a lack of convexity. And there is a value to a long volatility position that is misunderstood by the broad public and can be used. And I think that's what more you're referring to in this context. But regardless here, I want to emphasize adoption of options is not the tail wagging the dog, as is often said. We are moving from a time period where there is a dramatically better, think of it as a technology. You can trade any asset in 3 dimensions with much more precision. And the reason even though it's been secularly adopted over time, and options volumes have been increasing since I've been in the business pretty secularly and exponentially, but we've really hit a tipping point because the network effects have kicked in. There's more volume, there's more education, there's more access, there's more contract. All of this leads to a tipping point where more participants can now be involved and use these products and take advantage of them. And so that is leading to a complete takeover, essentially, of markets by something that is a dramatically better vehicle. And so I think learning about options, using them, adopting them is incredibly important. It ties into the macro because it also is more important in the adoptions accelerating because of higher interest rates and more non-correlated outcomes. So those two things are happening at the same time. And so we've hit this tipping point, this need for adoption, right as they're available and usable more than ever. And so I think that's critical to understand. I know I didn't answer your question directly, but now let's go to the part where we talk about kind of long volatility and what is long volatility and why would we want it in our portfolio and how does that function and why is that so important? Most people are used to, again, a very simplistic way of investing where they go to the investment store in a sense, and they go buy the investments that they like. They go shopping, right? And this is why people are kind of been taught that investing is easy and there's no real sophistication, when in reality, it's like, you have a health issue, you need to go to a doctor, you have a legal issue, you go to a lawyer, you have a new building built, you go to an engineer. Investing is the same way. There are higher levels of sophistication, but people haven't had to worry about that because they've been taught that markets go bottom left, top right pretty consistently. And when they have risk, it's very short-lived. But the reality is that you can improve your total returns dramatically by thinking through portfolio construction, not just betting on things that go up. You can dramatically reduce your risk and maximize your returns by not just being more efficient, but by hedging out the parts of the risk you don't want. Most people would look at something like a long volatility strategy, which is essentially a tail strategy that gives you convex returns if markets and assets go down, and see that in the long run, it loses maybe a little bit of money on average over the long run. Or maybe let's just say make 0% if you do it well. Okay. And they say, why would I bet on something that makes 0% in the long run? Why would I invest in this? I can go invest in the S&P 500, which makes 10% or 11% per year. So they don't do long volatility because they see it as, oh, that's a negative long-term outcome. What they miss here is, and again, this is the metaphor I love to use here, is that long volatility is like brakes on a race car. You don't take the brakes out of your race car, throw it out the window, because it makes you go slow. You don't say, hey, I want to win this race, so I got to get rid of these brakes. No, that's not how it works, right? Brakes in that situation make you win races. They allow you to go faster over the long run. Because what happens if you don't have brakes? If you continue to go fast with your gas, then you'll fly off the tracks at some point, right? So you have to go slow because people are aware there's risks, so they go slow. That's what bonds are all about. That's what cash is all about. People put like 60, 70% in stocks, and they're like, ooh, I got to hold all this money in cash because what if something bad happens over here? So the total goes way slower. People drive with only gas. But if you have brakes in your race car, then you have more control. You can not only slow down to the turns when you have risk, but you can accelerate out of the turns into the fairway and go max speed because you know you have brakes. Right? It's a critical concept. You could have a 10, 11% yielding S&P and a 0% yielding long vol, and allocate, of that stock and vol part. There's other parts of the portfolio I would recommend, but call it 10% or 15% to long vol and 85% to equities, and have a return that combined through rebalancing, because you can improve your geometric returns of 13, 14, 15%. That doesn't compute to most people. The key is you don't just put your foot on the brakes and put your foot on the gas, because if you put your foot on both, you're going to go slower. The key is brakes and gas. Brakes and gas is control. When your long vol pays out, you have a vol event, markets are down. What do? Go monetize your hedges, push it back into equities. Take risk. Go not just in equities. At that point, you have a moment where nobody else has cash, where you are liquid and you have all these returns and opportunities are rife. They're everywhere. Go take risk. And when markets are doing incredibly well and things have gone incredibly well, valuations are high, risks are on the horizon, file some away in insurance. Put a little bit away, take your profits and move a little to the long ball. And through this repeated rebalance of gas and brakes, the total returns of the portfolio go through the roof. And not just the returns, but importantly, the risk collapses. And so you can take an asset like equities, which have a 0.35 Sharpe over the long run, and achieve a 2 Sharpe for the combined. That's 6 times better, 5 times better total returns on a risk-adjusted basis. And not to mention, if you're doing this and you're at a 2 Sharpe, go take more risk. If you're a risk seeker and you're not just focused on Sharpe, but you just want to make a lot more returns, go put some leverage on it. That is how you make a lot of money over the long run. And so this idea of using long volatility portfolios is incredibly powerful. You cannot look at it in 2 dimensions and say, this is a poor returning thing, this long vol. Why would I invest in it? It is a tool, much like brakes are in your car, to go faster as a whole. You have to think about portfolio construction.
You're basically describing the safe haven portfolio that can survive some very hard times, correct?
Yes. But again, these are well-documented academic research that allow you to, most things, if you do things 50% better, usually you take over the whole market, right? We're talking about something that's 500% better. This is not and it's not because I have some alpha or this is some edge. It's by using the tools that are available to people. People just need to use those tools to improve those outcomes. There's a lot of education that needs to happen and a lot of understanding of why and how to use these things, right? But the tools are there, and it's not about market timing per se, or these are. It's a matter of construction through both diversification and through using convexity in portfolios and rebalancing structural level to take advantage of those. And they're pretty, again, well documented.
Where would you
ideas that can
recommend
get you to dramatically
someone
better
starting
outcomes.
right now who is interested in volatility in what you're talking about to just go and read? What would be your advice here?
Candidly, I think the best thing is to understand statistics. I think you don't have to have a deep understanding of statistics, but I think, our minds actually work in probability. We don't necessarily realize it, but all of us think in things of when you're making decisions, there is a complex kind of decision of probabilities going on in your head. And so bringing this to the rational kind of frontal cortex in your brain and learning more structurally to how to understand those processes and being able to actively think about risk and distribution. Again, risk is a kind of bastardized word in a sense, right? It's thinking about probabilities and thinking about the world in probabilities. Once you do it, it's like the red pill, right? It's like everything you see in the world is a probability, and how you think through, you get to better decisions across your life. And so I could give you a bunch of options books, and you could go learn the math behind Black-Scholes, and you could do all these things. And honestly, you'd spend a lot of time focusing on the details that are probably less critical. I'm not saying those things aren't valuable as well, and you should generally understand these things. But I'm a big believer in that. You learn statistics, you understand how these what options are and how they actually work. They're essentially insurance contracts, and generally how that the basic ideas of how those work, and then you go take a look at history. I think history is a great a great lesson to data. That's what I would recommend. A little different than your average kind of recommendation for sure, but I think that's going to inform your understanding of the world and markets much better than somebody telling you about kind of options, how they work and whatnot. But again, a broad education I find to be
Completely
much
agree. I
more
mean,
valuable
thinking in
than
bets
a very deep one.
is actually the mindset that every successful investor that I've met has, and it broadens your horizon. You start thinking in more dimensions than the average investor. So you're prepared for almost everything. Yeah. Cool. So I want to shift the conversation to the bigger picture, because you've said numerous times that the next decade could feel a bit disappointing for traditional investors, being passive or 60/40 type of investors. In simple words, what has changed in the world that makes the old buy and wait logic less reliable? At the moment, interest rates are, they are stuck around 3%. In Europe, 2%. So they are low, and they're comfortably low in a sense. Where do you see the biggest risks lying ahead for the larger picture that paints a harder decade ahead? Yeah.
Yeah, so this could be a whole other podcast, by the way. This is a complicated topic. So I was trying to summarize my views in a relatively short period of time here. But I think it's important to note that or if you widen the lens, 40 years feels like forever. Most track records in investing are like 10 years or something, maybe 20. But if you take a bigger picture and you start to understand history and dynamics, we tend to have big structural changes in the way the world works much more frequently than people understand. There is a tendency for us to go through several different, a couple different kinds of cycles. At our core, right, without government, and this is a big picture idea, we are all participants in something that's free market type situation, right? It's a survival of the fittest, evolutionary process, and through that process, generally money flows to the top. Power, absolute power corrupts absolutely, right? The better solution, the better technology takes over and wins and takes the whole market share, right? And so naturally, in these systems, human beings have no such thing as fairness. There is no fairness, right? Like in the animal world, right? And your mother, I'm sure, told you at some point, life is not fair. It's true. Life is not fair. The natural system is what I would consider a free market,
Yeah.
Republican.
My mother,
right
my mother taught me
approach,
moral
right?
relativism, which is basically the same. Yeah.
Yeah, and that's the reality, right? And you go back to Greek and Roman times, or even before that, like this idea of left and right is a very old idea. This idea of fairness, I think Socrates said, had a big Socratian question which is, do you give the best violin players the best violins, or do you give the worst violin players the best violins? This is that same question. Do we do what's fair, or do we do what creates the best outcome, right? And the reality is, what distinguishes us from animals by physiologically, and hence also culturally, is that we have a bigger frontal cortex. We have true executive function. Executive function is done through objectification. We control and manipulate the world around us through understanding things as independent things. That's what makes us different. And if you can do that, that means, Miroslav, you are a person and I am a person. And there's some level of equality or difference between us, but we are in some sense equal. And so the idea of fairness, of justice, of equality, all of which are the same thing, are a human construct that is core to who we are, and it is inescapable from our beliefs. And I believe in those things as well. It gets to moral and other things as well. Okay. And in some ways, it's allowed us to thrive. It's allowed us to live together and create some level of peace and structure to our world. But what most people don't understand is that structure is in complete contrast, structural, like it's in conflict with the natural system. And this is what creates left and right. It's what creates booms and busts. It's what drives incredible innovation and then revolution and collapse inevitably. Big picture. So to then take that structure and that knowledge and to say that markets will stay the same and will not go through cycles and things will maintain this type of onward is incredibly naive. The arc of history says that we have to go through these cycles and these booms and busts. Right? And so we've had 40 years of free market economics on steroids. We've pushed interest rates from 20 to 0, which has driven dramatic wealth inequality and incredible technological innovation, globalization, record profit margins, you name it. This is free market economics. Great outcomes for progress, not great outcomes for fairness or justice. And what does that do? If you do that for 40 years, what does that do now to the human experience? Because if you were born in 1982, you have now for 43 years experienced one thing, which is increasing inequality, increasing technological development, right? And a system which doesn't probably work for you, which doesn't prioritize median outcomes, just sends all the benefits of progress to the top. No, it drives a generation or two, or going on 3, that aren't very happy and feel that this is very unfair and unjust. And these populist waves eventually move us away from free market economics, often for decades at a time. And those things are less efficient, slow progress down, create a system that is more fair and where median outcomes tend to be prioritized. But total progress and maybe GDP growth is not. And I've been talking about this for over almost 6-7 years now about what's coming. And it also leads to protectionism by definition, because it's our people versus your people, right? Like that's just what populism is. It's by definition almost selfish, right? And it takes us away from globalization to deglobalization, from cooperation to competition, and global conflict. This is a tale as long as time. And so this is where we are heading. Again, I said this 7 years ago. This is not something new. And if you can't see where it's going, then I can't help you. And the reason it's happening is because it's generational. The baby boomers are dying off, and a new generation is coming to political dominance that believes these beliefs are as important, more important, and that things need to be remedied. And so this is not a linear outcome. It's not a 1-year thing, but these are the big cycles of time, and these are the things that matter. And when that happens, interest rates go higher because the system is more inefficient, right? Inflation, money starts going to people who spend money as opposed to capital on the top, which invests money. And this leads to structural inflation, higher interest rates, and that kind of drives a lot of the outcomes we've talked about. But that's a short summary.
It's changing environment when the pendulum swing or has been swinging in one direction for many decades and many generations. 40 years.
40 years.
Yeah.
And the adjustment is also generally not
and
just
the logical consequence is higher taxes,
right?
more debt, as we see, high interest rates, tighter margins for some companies. We already see this with the concentration of stocks and the delayed increase in profits in some companies. We can talk about this for hours. I'm very curious on your opinions about this too. But I have 2 last questions for you, because I know you have to go. Let's say that you are a regular investor here in Bulgaria. You now have a few ETFs, probably some crypto, some gold. Knowing everything you know today, what would be your first step to create an investment strategy?
There are several, as I alluded to before, fundamental kind of well-documented edges to maximize the risk-adjusted returns. And again, people confuse. I want to reiterate: maximizing risk-adjusted returns, Sharpe ratios, Sortino ratios, however you want to measure it, does not mean that you have to take less total risk. You can take the same amount of risk and get dramatically higher returns. The key is optimizing to risk-adjusted returns. Once you do that, then you can decide how much risk you want to take, right? You got gas and brakes. You can go faster if you have more control. That's the key. And there are several tools that everybody should deploy. One, I want to reiterate that word, true diversification. It doesn't mean 500 stocks that are all correlated. But people should be increasingly in strategies and things that are not correlated. I have 20 different investments that have a 10% annual return, a 0.5 Sharpe ratio, and a 15% annual drawdown, and I put them all together, and they are all correlated. My portfolio is the exact same. If they are completely non-correlated, a magical thing happens. You have a 10% return still, but your Sharpe ratio collapses. It goes up to 2 6 times better, because you only have 5% in each little non-correlated investment. Your drawdown, which was 15% per year, collapses to 3, because you can only have 5%, 20, in each one. The key is non-correlation and understanding what's non-correlated and what's not. And there are things that are very structurally non-correlated. The key is moving away from assets, not only being in assets, because assets tend to be correlated. So that's one. Cheat code. It's well known, but very few people deploy it. It's incredibly powerful. And again, once you get to that high risk adjusted return, by all means, go crank up the risk if you want. Add leverage if you want. 2, there are incredibly powerful tools like long volatility that can help you control your volatility and it can help you manage your race car in dramatically better ways. Learn about how to use them and use them in a way that allows for you to take the right risks and have more control in your portfolio so you don't get offsides or in a situation, because there are going to be more non-correlated outcomes in the next decade. And so managing risk matters more than ever. It's always the right idea, but particularly in the environment we're heading into. And by rebalancing those, don't just sit in them. They have to be actively used. Okay. But if you do that, you will improve your geometric returns. That's the second big idea. 3, fundamental value will matter more in the next decade. As the value of money goes up, the value of things that have fundamental value goes up. Nobody really cares that much about those things in a world that is peaceful and there's access to everything you need and a world of plenty. But if we go into a world of competition, resources, hard assets matter more, right? But also things of fundamental value that matter more. What is something actually worth? If there's not free money floating around it, where every company who doesn't have earnings can access, they have an idea and that's enough. Well, great. That's a good time for growth stocks when interest rates are 0. But if interest rates go to 7 or 8 or 10 or who knows where they go, or even stay here at 5 and everybody has to refinance, right? A lot of the best ideas will wither on the vine or only be able to be built by those who themselves generate cash flow. So valuation matters, growth matters, right? Looking at profit margins also for companies as interest rates go higher will reduce your risk. That's an important concept as well. The biggest risk to assets is higher interest rates. So you want to be hedged to higher interest rates. Okay. And one way to do that is to invest in businesses. Not all businesses are correlated the same on profit margins. They're correlated based on multiples, but their profit margins can, some about 25% of equities currently have dynamics that improve profit margins as interest rates go up. And those are the cohort of businesses you should be much more focused on, if nothing else, not just as a bet, but importantly as a way to reduce risk relative to your return. And then lastly, not just in long volatility, but really try and understand how you can use options and these vehicles to bet on a non-correlation and the bets you want and be more capital efficient in this environment. That's, again, another cheat code that's out there and available. You just need to educate yourself. So I think if you use these tools, then by all means go take the big kind of barbell risk where you're betting on the AI bet or whatever other bet, or the crypto bet, or whatever bet you want to make, and maybe bet on all of them. But you need to do that in a way that uses these tools that allows you to go seek risk and take kind of some of these bigger bets, and to do it on stable ground. I think that's the advice I'd have for anybody, whether you're in Bulgaria or not.
Where they can learn more, go deeper to better understand how you think with risk, volatility, portfolio protection, or where they can learn more about your work or the funds you manage, the products that you have.
Yeah, as I was saying earlier, unfortunately, investing has gotten to a point where people have lost the story, the script, the understanding. Everything in this world, there are experts. There are true experts that can provide dramatic value. Again, medicine, law, engineers. It's no different in investing. but it's gotten to a point where people don't think that investing is easy and that they know it. It's simple, just buy stuff and it goes up. And unfortunately, the overwhelming majority of investment houses, asset managers, wealth advisors provide little to no value because they're not experts. But if you can find people who are experts in the space, you don't have to learn it all yourself either. Some of these things are complicated and expertise matters. So that's what we try and do for people. We try and be their true advisor in that real sense. These people come to us, they're the kings of their domain, and we're there to advise them and help them truly get optimal outcomes by using a lot of these things we talk. KaiWealth.com, KaiVolatility.com. Kai Volatility is our asset management business. Kai Wealth is our advisory business. We do wealth advisory for high net worth family offices, bigger entities. So please come reach out there. That's a wonderful place. If you, we love to educate. We do a lot of podcasts and really try and kind of help and make an impact. Life is short, and it's wonderful to be able to make an impact and help people. So happy to chat. And again, wonderful meeting you.
Wish you all the best, Чем. Thank you.
Thank you.